Hello everyone and welcome to edupediaworld.com. Today we are going to continue with Unit 2 of Chapter 1, that is Accounting Concepts, Principles and Convention, and today we are going to do some more accounting concepts on which the total accounting is based. So let us start today's class. In today's class we'll be doing the accounting concept of conservatism, consistency and materiality. So let us start with the accounting concept of conservatism. What do we mean by the concept of conservatism and how it is applied? Conservatism. What do we mean by the concept of conservatism? Conservatism states that the accountant should not anticipate income and should provide for all possible losses. So in this concept, it is stated that whenever we are accounting for the business, we should not account for the anticipated income and we should provide for all the anticipated losses. So for example, if there is a situation in our business in which it is anticipated, that is, it is possible, it may or it may not. So it is a hypothetical situation. It is not up till now confirmed that we will earn only, but it is just assumed by the owner that he may earn some income in the future. So if this is the situation, he cannot just account for that anticipated income in his accounting books. But if the same is with the losses, if he is anticipating some losses in the near future in his business, due to any reason, but he is having in his mind that in the near future he will be incurring some losses due to some reasons. So in this case, he can account for those possible losses in the books of accounts. So this is how the concept of conservatism works. We cannot account for the anticipated income, but we can account for all the anticipated losses. Conservatism itself means that we are being conservative. We are just looking, you can say you are being a pessimist. You are assuming that all the possible losses which are anticipated will become a reality. That's why we are accounting for it. But all the anticipated income which we are thinking that we may earn, we will not materialize and will not realize that income. So you can, one way it can say that it is a pessimist concept. You are being a pessimist. You are thinking negatively. All the incomes, all the anticipated incomes will not realize, but all the possible losses will materialize. So this is how this concept works. Got it? The realization concept also states that no change would be counted unless it has materialized. In the realization concept, we have learned that we should not count for any change unless and until it is materialized. So this conservatism concept puts a further break on it. It is not prudent to count unrealized gains, but it is desirable to guard against all possible losses. In the realization concept, it was given that until and unless any gain is materialized, we should not realize that gain in our accounts. It was given that. Now the conservatism concept is further saying that the gains should not be realized, that is there, but apart from that, all the losses which are anticipated, that should be accounted for and that should be guarded against. So this is how the conservatism concept works. We should just account for all the anticipated losses, but we should not take into account any anticipated income. The next concept is the accounting concept of consistency. The literal meaning of consistency is to follow any procedure or anything regularly and without changing it. So consistency means being unchanged or not changing. This is the literal meaning of consistency. The same meaning applies in the concept. The concept says that the accounting policies should be followed consistently from one period to another That is, any accounting policy that we are following, for example, in depreciation, we are providing depreciation on the machinery acquired by us in the business on WDV method, that is written down method, written down value method. There are mainly two types of method of providing depreciation. That is, one is straight line method and the other is written down value method. So that is called SLM and WDV. So mainly there are two types of methods of providing depreciation. So I can use the SLM method or the WDV method. Now, if I am using the WDV method of providing depreciation on my machinery items or any asset, then I have to follow that method only consistently from one period to another. It shouldn't be like that I am using SLM in this year and in next year I am switching to WDV, that is written down value. This should not be there. This is the concept of consistency. The accounting policy that we are following should be followed consistently from one period to another. A change in an accounting policy is made only in certain exceptional circumstances. Here it is given that the accounting policy can be changed only in certain exceptional circumstances. So if there are these exceptional circumstances which we are going to learn in the coming slides, what are these exceptional circumstances? If those circumstances are there, then only the accounting policies could be changed. Other than that, the accounting policy should not be changed and they should be followed consistently from one period to another. Now, what is the reason behind this concept? The reason is to achieve comparability of financial statements of an enterprise through time. This concept facilitates the comparison of the financial statements through time. If we are following WDV in one year and in next year we are following SLM, then it hinders in the comparability of the financial statements. The financial statements cannot be compared because the accounting policies have changed. How can you compare two financial statements in which different accounting policies have been followed? This difference creates big difference in the profits in various assets. So this creates problem. So in order to achieve comparability, comparability of the financial statements, this concept should be followed. The concept of consistency, that is to follow the accounting policy consistently from one period to another without changing it. Let us see this example. Company may adopt any of several methods of depreciation such as written down value method, straight line method, etc. As we have discussed in the previous slide, this policy of depreciation, that a company has an option of following any of the methods of depreciation, whether WDV or SLM. Likewise, there are many methods of valuation of inventories, that is the stock which the company is holding. There are many methods of valuation of that stock also. So, the company can adopt any of the method while providing depreciation or while valuing the inventories. But following the principle of consistency, it is advisable that the company should follow consistently over the years the same method of depreciation or the same method of valuation of inventories, whichever is chosen. So, it is the pure choice of the company to adopt any of the method for providing depreciation or providing the valuation of inventories. But in order to follow the concept of consistency, it is advisable that the company should follow consistently over the years the same method. The company is required to follow the same method of depreciation or the same method of valuation which is chosen by the company. So whatever method the company chooses, it is the duty of the company now that they have to apply that method only consistently over the years so that the comparability of the financial statement is there. If they keep changing the accounting policies year after year, then the comparability of the financial statements become very, very difficult, and it is not feasible also and not advisable also. These accounting concepts have been developed for the pure purpose of comparability of the financial statements, various financial statements of different entities for different years. So if the company don't follow this concept, then it will not render the financial statements comparable. It is advisable for the company to follow this concept of consistency and apply whatever method they have chosen over the years and do not change them. Now let us see the exceptional circumstances under which an enterprise is given the chance of changing its accounting policy. The concept of consistency says that the enterprise shouldn't change the accounting policy year after year and should remain consistent with the accounting policies. But here are the three circumstances, exceptional circumstances under which the enterprise is allowed to change its accounting policy. What are they? Number one is to bring the books of accounts in accordance with the issued accounting standards. What happens is that sometimes the accounting standards are changed or updated, or certain parts are deleted every year, or you can say that at any time they are updated as per the laws prevailing in the country or as per the notifications of certain official bodies. So the accounting standards are updated as per that. So if that is the case, then the books of accounts, the enterprise has to bring the books of accounts in accordance with those accounting standards, and for that they have to change certain accounting policies. So this is the case in which the company or in which the enterprise can change the accounting policies in order to bring the books of accounts in accordance with the issued accounting standards. If the accounting standards are changed, or if new accounting standards are issued, which makes it necessary for the enterprise to bring its books of accounts in accordance with those accounting standards, and it requires the change of policy or some change in the methods followed by the company initially, then in that case the enterprise can just change its accounting policy and can adopt a new accounting policy as per the issued accounting standards. We will study about these accounting standards in the next unit, what are they and how they operate. Number two is to compliance with the provision of law. So sometimes it happens that there is some change in the law, and which requires the enterprise and all the companies to just bring their books of accounts in line with that law and with that change. So that requires the change in accounting policy. So if that is the case, the enterprise can change its accounting policy and brings its books of accounts in order with the change in law, whatever has been changed or whatever has been updated or deleted, whatever may be the case, because the law keeps changing as per the situations prevailing in the country. New provisions are coming, so the companies has to comply with those provisions of law, and for complying with those provisions of law they have to make certain changes in their books of accounts. So in that case these changes are allowed. And lastly, when under changed circumstances it is felt that the new method will reflect more true and fair picture in the financial statements. It happens that the circumstances have changed, the technology has changed, because as we know the world is growing very, very fast and every day something new is coming. So everything is undergoing a fast change. So when it appears to the enterprise or the owner that the circumstances have totally changed, what they were initially and what they are now after so many years, it is required and it is felt that the new method will reflect true and fair picture of the financial statement. It is being assumed by the owner that the method that they are following is not reflecting the true and fair picture of the financial statements now, as it used to reflect previously or initially some years back. Now it requires a change to reflect the true and fair picture of the financial statements. So in that case, the enterprise can change its accounting policy just to bring the true and fair picture of the financial statement. So these are the three cases in which the accounting policy can be changed and the concept of consistency can be given away. Number one is to bring the books of accounts in accordance with the issued accounting standards to compliance with the provision of law. When under changed circumstances, it is felt that the new method will reflect more true and fair picture of the financial statement. So you can learn it like this way: accounting standards, provision of law, and true and fair picture of the financial statement. These are the three cases in which the accounting policies can be changed. The next concept is the concept of materiality. What does this concept say? It says that all the items having significant economic effect on the business of the enterprise should be disclosed in the financial statements, and any insignificant item which will only increase the work of the accountant but will not be relevant to the user's needs should not be disclosed in the financial statements. This concept says that items having significant accounting effect or economic effect, you can say, significant economic effect on the business should only be disclosed, and all insignificant items which will only increase the work of the accountant and which are not significant at all to the users and which are not relevant at all to the users should be given away and should not be disclosed in the financial statements. So we can say that, for example, if the company is purchasing any land for rupees 2 crore, 3 crore, so that is having a significant economic effect on the business and that will affect the financial statements in a very significant way. So that is required to be disclosed in the financial statements. But if you say that the company has purchased stationery worth rupees 200, or you can say the company has incurred miscellaneous expenses of rupees 500, so that is very insignificant as compared to that purchase of land for rupees 2 crore, 3 crore. So that is very insignificant as compared to that transaction of the purchase of land. So if we do not disclose it in the accounting statements or financial statements, it does not affect the users in any way and it does not affect the financial statements also in any way. So this is what the concept is saying. The transactions which are having the significant economic effect on the business and on the financial statement should be disclosed, and the items which are insignificant and which is just a burden for the accountant to account them, so those should be ignored and should not be disclosed in the financial statements. Now let us see some points on this concept of materiality. The term materiality is a subjective term. It means that we cannot particularly and we cannot define exactly what do we mean by materiality. It is a subjective term and it differs from person to person, organization to organization. So it is a very subjective term because it may happen that if one thing is material to my organization, it does not mean that it can be or it is material to the other organization also. So it depends upon the organization whether the particular item is material or immaterial to them. It is on the judgment, common sense and discretion of the accountant that which item is material and which is not. It depends on the accountant whether he thinks that a particular item is material or immaterial, or whether the accounting of a particular item will affect the financial statement or the non-accounting of the particular item will affect the financial statements or not. So it is solely on the judgment, common sense and the decision of the accountant. So here example is given. For example, stationery purchased by the organization though not used fully in the accounting year in which it is purchased, is still shown as an expense of that year because of the materiality concept. As we have discussed in the previous slide also, that stationery is a very trivial item of any organization. So if I am spending rupees 500 on the stationery items and I'm just using 200 worth of stationery items, still I'll show the full 500 in my expense rather than showing it as a asset in my balance sheet, just because it does not matter whether I'm showing 500 or 200 as stationery in my books of accounts. So this is what we are trying to say by the concept of materiality, how it affects the financial statement. If I will write 500 also, that will not make much difference. If I'll give 200 also, that will not make much difference. So it depends how much difference it creates in the financial statement. Similarly, depreciation on small items like books, calculators, etc. is taken as 100% in the year of purchase, though used by the entity for more than a year. This also comes in stationery also, but these are categorized as asset. So books and calculators which I am buying in 1 year, I am writing them off 100% in the year of purchase only because they are very trivial items. So I cannot just provide depreciation at 10% and show them in my balance sheet as assets, because these are very small items and it hardly makes any difference whether these items are shown in the balance sheet or not, because they are very small items. Books, calculators, though I'm using them for so many years, but I'll write them off in the first year only because they are very trivial items, and write them off as expense only in the first year rather than showing them as asset in the balance sheet year after year. So this is what happens in the materiality concept. The items having significant effect are only accounted, and the items which do not have any significant effect are ignored. The materiality depends not only upon the amount of the item but also upon the size of the business, nature and level of information, level of the person making the decision, etc. So this is given that it does not depend wholly and solely on the amount. So if I'm saying that if any expense is of rupees 500 should be immaterial, that is not the case. Amount doesn't matter. What matter is the size of the business. For some business, that 500 rupees expense may be material, but in some business that is immaterial. So it depends upon the business, the size of the business, the nature and level of information, what level of information it will be providing to the users if I'll account it in my financial statements, and the level of the person making the decision. The persons to whom the financial statements will be presented, whether those transactions whether material or immaterial, what effect will that transaction will have on the decision. If that transaction is not going to have any impact on the decision of the person, then that is not accounted for. But if I am thinking that a certain transaction is going to have a bigger impact on the decision of the person who is using the financial statement, then that transaction should be accounted. Moreover, an item material to one person may be immaterial to another person, as I have said previously. It depends upon person to person and organization to organization. Now, what is important is that omission of any information should not impair the decision making of various users. The main purpose of this, the underlying purpose of this concept is that we should not omit any information which could affect or impair the decision making of various users. So all the information which is important for the decision making of various users should be anyhow reported in the financial statement, and whatever information we think is not important for the decision making purpose can be eliminated. Thank you, students. Hope you understood the concepts of conservatism, consistency and materiality in a better way. And now you will be able to answer the MCQs based on these concepts in your examination properly and correctly. Thank you.